Welcome and thank you for joining me in this Options Trading for Beginners video. This is your complete guide to everything you need to know about options in the stock market. This includes call options, put options, covered calls, and cash-secured puts. If you want to become a more powerful investor or trader, then watch this video from start to end. This knowledge will enhance your skills and ability to profit when the market is volatile, flat, or trading sideways. First, let me tell you one important thing. Do not rush. Take your time and rewatch parts, so that you can fully grasp the information I am about to share. I was intimidated and overwhelmed the first time I started learning options. Today I wouldn't be able to imagine investing or trading without them, so please make sure to like and subscribe so I can continue to make these types of videos. Let's start with call options. So what are options? Options are simply contracts. It's a deal between you and another person. I want to show you this from the perspective of the buyer. You will be the buyer of the call option contract. Now in this example, we will use Tesla stock. So the price of Tesla as I am writing this is at $305.30. Let's keep it simple and round it down to $305 a share. So what if I say to you, I'll give you the option to buy Tesla at $315 a share in the next 30 days, and it will cost you $10 a share, which is called the premium. One thing to know about an options contract is one contract equals 100 shares. Keep in mind, we do not know if the stock price will go up or down in the next 30 days. Now you have the option to buy Tesla at $315 within the next 30 days. So here's how you win. Let us say the price of Tesla right now is at $305, and let's say that the price of Tesla hits $340. In this situation, you are going to make good money. Here's what's happening. The options contract that you bought was a call option, and you paid for the option to buy a stock at a certain price. This is called the strike price. The contract period is a 30-day period called the expiration date. Now in my example, let's say Tesla stock hits $340, and you have the option to buy Tesla at $315. Would you buy Tesla for $315? Of course, you would, because you could buy it for $315 and then immediately sell it for the going rate of $340, leaving you with a gain of $25 per share. So here's what your profit would look like. You buy Tesla at $315, you sell it for $340, but you must remember that you paid $10 to have this option, so you are left with a net profit of $15. I will show you what it looks like on my platform. Keep in mind for this example, I did not use the actual price of the $305 call option. As you can see in the red outline with a 29-day expiration, the cost of the $305 call option is $16.70. Do not be intimidated. I am going to walk you through this, and it's going to be very easy to understand and make perfect sense by the end of this video. So on the left-hand side, these are all the call option contracts at different price points. If you want the contract to be at $320, then you would select the $320 strike price with the 30-day. Or in this case now 29 days, and you will see that would cost you $10.65. You can pick any strike price, $350, $360, $370 and up. These strike prices are just a limit of my screenshot. You can pick higher. Strike prices like $500 or even $600, but I'm going to explain the difference to you later. But for right now, let us just focus on you buying the call option. So let's go back to the topic of you winning and making money. TESLA is at $340 currently. You bought the call option with a strike price at $315, and that option cost you $10. If Tesla goes above $315 in the next 30 days, then you are going to be in profit. This is called in the money. If Tesla skyrockets to 400 or let's say 500, then you are going to make a lot of money because you have the option to buy it at $315. So when you buy a call option, that means you are bullish and want Tesla to go up as much as possible as fast as possible. It's pretty straightforward. Tesla goes to 400, you can buy it for $315 and then sell it immediately. This is the best scenario where everything works out and you make a lot of money. But let's talk about the flip side. How can you lose money? How can you get absolutely destroyed and lose it all? The danger is you have a limited amount of time before your contract expires. Remember, that's called the expiration date. Let us say the stock price doesn't go above your $315 strike price in that set amount of time in your contract. Your contract would then be deemed worthless. Here is how that unhappy scenario would play out. Tesla is at $305 right now. You bought the call option to have the option to buy Tesla at $315 in the next 30 days. If Tesla is at $315 or below by the time the 30 days is up, then your contract is worthless. Let me demonstrate the good and bad scenarios for you. Example number 1. Tesla is at $305 per share. You have the option to buy it at $315 within the next 30 days. And let us just say that the stock price goes down to $310. In this scenario, your contract is worthless. Why would you use your contract to buy Tesla at $315 when you could just buy it on the open market for $310? And remember, you paid $10 for that contract, so you lose. Example number 2. Tesla is at $305. You have the option to buy it at $315 within the next 30 days, and let's just say that the stock price goes up to $314. In this situation, it's the same thing. Why would you use your contract to buy Tesla at $315 when it is cheaper on the open market? So yes, the price of Tesla stock did go up. However, it did not go up enough, because it's still below the strike price on the contract plus what you paid. That would be a $10 loss per contract you paid to have the option. Example number 3, Tesla is at $305, and you have the option to buy it at $315 within the next 30 days, and Tesla goes up to $320. So in this scenario, you can buy Tesla for $315, and you could sell it for $320, leaving you with a gain of $5. However, you still lose money because you paid $10 for the contract. Your break-even price is really $325, so you still lose, but at least it's not a total loss. Example number 4, Tesla is at $305. You have the option to buy it at $315 within the next 30 days. Tesla goes above your cost basis of $325. Now, you are in profit, and the more it goes up, the more money that you'll make. Apple decides to acquire Tesla for a price of $800 per share, and Tesla stock skyrockets in price within your 30 days before expiration. This is so important with call options or options contracts in general. You can buy and sell them just like a stock. So if Tesla goes to $800 a share, it does not mean you now have to buy Tesla for $315 and then sell it for $800. You can just sell the option contracts. If Tesla is at $800 and you choose to buy Tesla stock for $315, that is called assignment. What you are doing is exercising your option contract to buy Tesla at $315. Once the stock is assigned to you, your options contract will then disappear from your account. Now, let's go back to my options screen. What you are looking at is called the options chain. Options chain allows you to see all the call options at different strike prices and different expiration dates. Now, I want you to compare the contract at $315 versus $310. The contract at $310 is selling for $14.43, while the contract at $315 is selling for $12.39. So if you want to buy a contract with a higher strike price, the contract will be cheaper because it's less probable that Tesla will hit $315 as compared to $310. So the further out of the money or further away from the current strike price, the cheaper the contract. Next, I want to teach you about the duration of the options contract. If you are thinking that everything we are talking about sounds risky, because you have no way of knowing what is going to happen in the next 30 days, then I would say you are absolutely correct. 30 days is not a lot of time, but what if Tesla is at $305 and I will give you the same option to buy it at $315, but instead of 30 days? For expiration will give you 8 months. That scenario would be more appealing to you because you have more time for Tesla to go up. However, with those favorable conditions are taken into consideration, and you are going to have to pay a higher cost for that options contract. More time equals greater probability. Take a look. Highlighted in blue at the top, you can choose the expiration dates of the contract. So we are going to use the same strike price at $315 for a contract that expires in 8 months. This contract is going to cost you $51.01, compared to the contract that expires in 30 days, that is going for $12.39. The closer the contracts are to expiration, the cheaper the premium. If the expiration date is farther out, then the contract will be more expensive. There is one very important thing to remember: option contracts are for 100 shares. So if you buy one option contract of Tesla at a $315 strike price, then you are buying the option to buy 100 shares of Tesla at $315, and the contract price or premium is quoted at $12.39. So, if the options contract will cost you $1,239 and you buy 5 option contracts, that will cost you $6,195. I hope that this has helped you to better understand call option. Now, in this next chapter, I am going to teach you covered calls. We are still going to be dealing with call options, but we are going to be taking it one step further. I will show you how to decrease your risk and generate passive income. I am going to explain how the best funds use covered calls and why their investors love them. I am going to show you how to do it and what options are available to you in the event you make a mistake of not wanting to lose your shares to an assignment sale. If you think that covered calls are complicated, they're not. It can be intimidating at first, but by the time I am done outlining everything, you are going to become a much better investor and wonder where covered calls have been your whole life. I am a huge fan of covered calls, especially when my holdings are down, because it gives me a steady stream of income and allows me time until my targets are hit. Let's go over the good and the bad of covered calls. We'll start with the good. The good thing about a covered call is that you will be paid a passive income like a dividend. This could be weekly, monthly, annually, or a complete mix of weekly and monthly throughout the year. You get to decide the expiration dates. You make money by selling the call option. You cannot lose money by selling the call option. Yes, you heard me correct. Let me be crystal clear. You can only lose money on your stock, but you cannot lose money on the sale of the call option. It is guaranteed money whether you are a beginner or advanced investor. However, there is a trade-off. The bad thing is, when you sell the call option, you are limiting your upside potential if your stock goes up. If you are freaking out or jumping to any conclusions, relax. I am going to be very clear and break everything down so it makes perfect sense. I'm going to show you the math to clarify this for you. In the previous examples, we were dealing with call options and you were the buyer. We are still going to be dealing with call options, but in these examples, you will be the seller. There are 3 scenarios where you sell call options. Example 1, you buy a call option and then you sell it. Scenario 2, you sell a call option. In the last scenario, you buy a stock and then you sell a covered call option. I am going to show you my personal real-life example, a real stock, the real price, along with the real call option prices. This is the best way to teach you and to also show you that all this knowledge is from me, a real deal trader. We're going to be dealing with one of my favorite stocks, Tesla. However, the ticker symbol is TSLL, which is a leveraged ETF. At the time of making this video, TSLL closed at $10.54 a share. To make it easy, and we are going to use the call option, I sold July 18th, and it expires July 25th. That was a 1-week option, with $11 strike price, which was sold for 84 cents. Again, what I am showing you is a real-life example. These are actual numbers, so please make sure to keep that in mind, because you are going to see how much money you can make. It can get kind of wild when you find the right option and the right market move. Here's the situation. Let's say that you buy TSLL at 10, and I give you an offer. So, I want the option to buy TSLL from you at $11 within the next week. Now, you are not going to give me that option for free. You are going to say, if you want that option, then it's going to cost you 84 cents. I say, okay, you got yourself a deal. So, I pay you 84 cents to have that option to buy TSLL from you at $11 within the week. So why would I do this? Let's work out some different scenarios and I will show you the math. Scenario number 1, the share price of TSLL goes down. You bought TSLL at $10 a share, and in a week later, TSLL falls in price from $12.50 to $10.50. So in this scenario, I will not use the call option that you sold me because I could just buy it on the open market for $10.50. So in this scenario, you sold me a contract that turned out to be worthless for me. Remember, TSLL fell from $12.50 to $10.50. You lost $2 per share on the stock, right? But you made 84 cents by selling me the call option. That's called a hedge, and even though it closed below $11, you still made 50 cents on the shares, plus the 84-cent premium you collected from me. So really, your P&L is as if TSLL shares we're at $11.34. Moving on to scenario number 2. The share price does nothing. You bought TSLL at $10. After 1 week, the price is unchanged and stays at $10. In this scenario, you didn't make money and you didn't lose money on the stock. But remember, you sold me the call option to buy TSLL from you for $11 a share. And I paid you 84 cents to have that option. But I'm not going to exercise that option because I could just buy it on the open market for 10. Again, in this scenario, your stock did nothing and you still made an 84-cent profit. So if the stock is $10.84. Let me tell you, making this type of profit in 1 week is not bad because 84 cents divided by $10, which is what you paid for TSLL, leaves you with a total gain of 8.4%. So, if you annualize that, that's a rate of return of 436%. And again, these are real numbers. Do you now see why the institutions love this? You're always making money until your price target is reached. Here is the last scenario. The price of TSLL skyrockets up. Remember, you bought at 10 and it is now 20. So, remember that you sold me the option to buy TSLL from you at 11 within the next week. So here is what I am going to do. I'm going to exercise it. I am going to buy TSLL from you at 11, and I am going to sell it on the open market for 20. So even though the price of TSLL shot up to 20, you are forced to sell it. To me, for 11, that was the deal. I paid you an 84-cent premium for that option. So you bought TSLL at 10, you sell it to me for 11. So you make a $1 gain on your stock, plus the 84 cents you collected when you sold the call option. So really you make $1.84 total profit. That's an 18.4% gain in 1 week, annualized. That's a rate of return of 956%. Now that's to say if every week in the year worked out like that. Still awesome, right? Now, let us say you did not want to sell your shares for $11 because you believe there is much more upside. What you would have to do next is find a further expiration with a higher strike price and swap them. That is called a rollover. You are closing out of your first contract and rolling into the new option contract with a longer expiration date and higher price. If you look at my screenshot, you will see I am currently in the process of rolling over an option of mine. I was paid 84 cents for selling my covered calls, and they are now expiring worthless. The best part is, I have been down from where I bought the shares originally. I paid $13 per share on June 11, 2025, and I have been selling covered calls every week. At first glance, you would think I am down $2.50, but in reality, I am currently up double digits. Now, with that being said, I want to ask you a question. Think about it and be honest with yourself. Would you have been upset if you made an 18.4% gain in 1 week? Imagine you never sold the call option, and your stock would have went up from 10 to 20, leaving you with a 100% gain on the stock. But you did a covered call, and you made a total gain of 18.4%. So, you sold yourself short. You still made money, but you would have made more money if you never sold me the call option. But of course, you didn't expect the share price to go up so high, so quickly. I guess it's just a matter of point of view. You'd either be kicking yourself or not over the situation. But that is the risk of writing a covered call. Again, when done correctly, you cannot lose money by selling the call option. The downside is that you are limiting your upside potential unless you roll over your contract. Remember, you can't go broke taking profits. Bears make money, bulls make money, but pigs, they get slaughtered. I hope that this is all starting to click, but I must show you two very important variables with covered calls: strike price and the duration. But first, if you are finding this video helpful, please give this video a thumbs up and subscribe. I am just trying to be helpful, so if you can help me by sharing my content, I'd really appreciate it. Let's modify the variables and see how the numbers work out. Let's change the duration of the contract. So the $11 call option 1 week out is selling for 62 cents. What if we change the duration to 5 months out now? I want you to remember, the more time, the more expensive the call option will be. This means the seller would collect more money. Let's look at the call options on TSLL, 5 months out instead of 1 week. The prices for the call options, as you can see, is $2.84 per call option. You would receive $2.84, but you may be thinking, why when I can sell the $11 call option in 1 week and make 67 cents? why not just sell the $11 call option and collect 67 cents every week? That way you will make a $13.40 profit instead of the $2.84 on the 5-month call option. The weekly option turns out to be better than selling a single call option 5 months out. However, the price of the call option is constantly changing. If the stock price of TSLL falls from $10 to $8, then the call option, 1 week out, would probably sell for around 30 cents or even less. So that is the risk that you are taking by going with a shorter expiration date on the call option. If you lock yourself into a longer expiration date on the call option, then you know exactly how much you are going to make in 6 months. Shorter time frames mean that you do not know how much that call option will be selling for when the time comes. You may get a better price, or you may get a worse price. So that is the risk you must be willing to take. Now let's change another variable. Let us change the strike price, so you can sell the $13 per call option 1 week out and make 10 cents. With a higher strike price, your potential is on the up to make money on the stock in the event that your stock goes up. You would make less money by selling the call option because you are only going to make 10 cents instead of 67 cents on the $11 strike price. If TSLL shoots up to 14, you are going to be forced to sell at $11 a share. However, if you sold the $13 call option, then you would be forced to sell at 13. So, the call option, the closer the strike price is to the current price, the more expensive the call option becomes. The further the strike price, the cheaper it becomes because it is less probable. Now let me show you how to write a covered call. To write a covered call, you need to buy the stock first and then sell the call option. So do not buy a crappy stock. You do not want to make money by selling the call option, but lose money on the stock. Remember, with options you are dealing with 100 share increments. So in this TSLL example, I already own 700 shares of TSLL. In this scenario, the first thing for you to do is place a sell to open order. Next, put 7 contracts in number of contracts section. Select your expiration date. In this case, I am doing August 1st with an $11 strike, and as you can see, this is going to pay me 58 cents and that's it. Piece of cake, very easy. If you have 1,000 shares, then it's going to look like this. Sell 10 call options or whatever you want, and you are going to notice that it says $557.55. That's how much money that you will make from selling 10 covered calls. Here's a breakdown of the math. The $11 call option is selling for 58 cents a share. Multiply that by 100 shares, and that's $58 for each call option contract. Multiply that by 10 call options that you are selling, and you make $580 minus any commissions. In my case, it's costing me $22.45. Many brokerage accounts will allow you to buy the stock and sell the call option at the same time, so it'll be simultaneous. Now, let me finish by telling you what happens after you write the covered call. As soon as you sell the call option, you receive that money immediately in your account. So it will automatically appear in your account like magic. You do not have to do anything else.
Wow.
Now after 1 week, the price of TSLL ends up above my $11 strike price, and I am forced to sell my TSLL, and I do not want to roll over my contract date. My TSLL shares would be sold automatically. I do not have to do anything. The brokerage takes care of it for me. If the price ends up below my $11 strike, then the call option that I sold expires worthless, and it's automatically eliminated from my account. Remember, I got paid up front for selling the call option. Now I want to share some last tips. The premium is a fancy way to say the price of the option contract. So if the $11 call option is selling for 58 cents, then that would be a 58-cent premium. The more premium, the better, because as the seller, you want to get paid more money for writing the contract in terms of how options are priced. Next tip I want to explain is more time on the contract means more premium. The closer to the strike price means more premium. The more volatile a stock is, the higher the premium. So regarding volatility, this makes sense because just think about it. If a stock is going up or down like crazy, then you deserve to be compensated more for locking yourself in a contract at a fixed price. Because who knows what's going to happen to the stock within your duration. When you are looking to write covered calls, make sure that the deal makes sense, because you must remember, the downside is that you are limiting your upside potential during the duration of the contract. If the risk is not worth the reward, then do not do it. Make sure to shop around for good deals. Sometimes there won't be any. Other times there will be a lot. Here are 5 tips. Number 1. Start small and learn. Number 2. Practice with a paper account. Number 3. Learn the Greeks, especially delta and theta. Number 4. Watch volatility. And last and most important, always use risk management, which you can find in my first video. Now let's move on to put options. Put options will be the complete opposites of call options. A call option gives you the right to buy a stock at a set price. A put option gives you the right to sell a stock at a set price. Calls are used when you expect the price to go up. Puts are used when you expect it to go down. Let's say I am the seller and you are the buyer. I am selling the put option and you are buying the put option. In this example, we will continue to use Tesla stock and the $305 stock price example. What if I told you within the next month? I will give you the option to sell Tesla stock to me for $305 and I'll buy it from you. However, I am not going to give you that option for free. That option will cost you $1, meaning you'll have to pay me $1. So ultimately, you bought the Tesla put option with a 1-month expiry for $1. In this example, let's say Tesla goes up to $320 a share. You are not going to go to exercise your option and buy it for $320 and then sell to me for $305, because that would be a loss of $15 a share for you. So how do you make money on put options? Thought you'd never ask. Really what you want is for Tesla stock to crash within the next month. If Tesla stock falls to, let's just say, $250 a share, then you would be very happy because you can buy Tesla for $250 on the open market. And then you could immediately sell to me for $305, leaving you with a gain of $55 a share. Remember, you paid $1 to have this option. Therefore, your true profit would be $54. This is what the options chain for Tesla, ticker symbol TSLA. Highlighted in blue, you will see 28 days to expiration. August 22nd, 2025. We are looking at the $305 put option, which is the strike prices in the blue. Column in the middle of the screen that's selling for $9.15. Now, let me give you a different example to show you how you lose money. You buy the $305 put option expiring in 1 month, and Tesla does not fall below the $305 strike price in that 1-month duration. Your contract would be worthless. Why would you exercise your option to sell it to me for $305 when you can sell it on the open? It's market for $315. So if the stock does not fall below your strike price before the expiration, then you wasted your money on buying the put option. Now, before going on, I need to tell you about the duration or time decay of the contract. I'll teach it to you like this. Here are 2 offers, and you tell me which one sounds better. Offer number 1, you can sell Tesla stock to me at $305 within the next month, or offer number 2, you can sell the stock to me at $305 within the next 5 months. Offer 2 would sound better because you have more time for Tesla stock to fall below $305 strike. However, this favorable condition is taken into consideration like call options. Take a look for yourself. Here are the put option contracts on Tesla for 1 month out. So the $305 put option is selling for $9.35. And look at the same $305 put option but 5 months out. So this same $305 put option is selling for $31.61, which is a big difference. So regarding the duration, the more time on the contract, the more valuable the contract. Time equals money. Check the same 305 option expiring in 1 week, and you are going to see that the contract will be a lot cheaper, $2.65. Check the same 305 put option that expires a 1.5 years from now, and that will be much more expensive. Now let me share something about the strike price. Let's look at 2 offers again, and you tell me which one sounds better. First offer, within the next month, you can sell me your Tesla stock for $305, offer number 2. Within the next month, you can sell me your Tesla stock for $315. Of course, offer number 2 is going to be better for you because you would rather have the option to sell me Tesla stock at a higher price. However, this too is also taken into consideration. Take a look for yourself. The $315 put option is $12.85 compared to the $8.83 put option. Therefore, a higher strike price is more expensive, and a lower strike price is less expensive. Just like call options, you are dealing with 100 share increments, So if you are buying one Tesla put contract with a 30-day expiration at the 305 strike price for $8.85, you are buying the option to sell 100 shares. That put option will cost you $885, $8.85 per share. Multiplied by 100 shares equals $885. Let me give you a live demonstration on how to exercise a put option. First, I put in the ticker TSLA. Then I select what type of contract I want to buy, either a call or put, and in this case, I selected a put option contract. Then you select how much time you think it will take for your thesis to play out. In this case, I selected the August 22nd, 2025 expiration date with a strike price of 305. My action is a buy, so you would select buy to open. If you are selling, you would select sell to close. Next, put the number of contracts, which is 1. Then you can either pick a limit price, which is what I would always recommend over market order. If you look to the right, you will see the bid and the ask. If you are wondering why I always pick limit price, you can see there is a spread in the bid and ask. Using a limit order ensures I always get the best price. One contract equals 100 shares, multiplied by $8.62. Plus a commission of $11.20, leaves me with a grand total of $873.20. Let's say that you buy the Tesla 305 put option and the stock falls to 250. You do not literally have to go out and buy 100 shares at 250 and then use your put option to sell your 100 shares at 305. You can just sell the put option itself because it prices everything in. The more time left into your contract, the greater your premium will be. No different then as if you were selling a stock. This is what it would look like, sell to close. Tesla falls to 250 a share. The 305 put option would trade for around $55. Minimum, depending if there is a lot of time left in your contract, so you would type in the price that you want for the put option, no different than selling a stock, and you would make $55 per share of the put option. $55 a share, multiplied by 100 shares, equals $5,500. Remember, you bought the put option for $862, which is a total cost of $800.62. Now you can sell it for $5,500. By now you've probably realized two things. Number one, if things work out well, then you can make a lot of money. But number two, if the stock price doesn't cooperate with you within your time duration, then you lose everything. Now this is very important. What I just showed you is the most basic way to utilize a put option, but this is not the only purpose. Now in our next segment, I am going to show you how to use put options to decrease your risk and generate passive income. Let us say there's a stock at $10 a share, and you think that it is a good buy at 10, but you can create a situation where you can buy that stock for 9. And if it turns out that you cannot buy it for 9, then you will get paid regardless. This is called cash secured puts. A cash secured put allows you to buy any stock at a discount, and if you cannot, then you still walk away with the premium you were paid. Think of car insurance. You pay, and the insurance company is only on the hook if you get into an accident. They do not refund your premium you have been paying every month. Our accident in this example is the equivalent as you having to buy the stock at a fixed price you picked. Sounds too good to be true. It's not. Let me show you. Personally, I believe that the pros outweigh the cons. But I am going to show you both sides of the story and you can be the judge. Let's stick with Tesla. Tesla is at $320 a share, and you think that it is a good buy at these levels. So you can buy the stock at $320 and just hope that it goes up. Or another option is that you can do a cash secured put. By doing so, you lock yourself into an agreement as follows. You are committing to buy Tesla at $320 within a 1-week expiration date. If Tesla falls below $320, you will have to buy Tesla at $320. And it doesn't matter how low Tesla stock drops. You are on the hook to buy at $320 a share. That means if Tesla stock drops to $310 within that 1-week contract, you are on the hook to buy Tesla stock for $320. If Tesla does not fall to $320 or below, then you will not have to buy Tesla. However, regardless of which scenario occurs, you will be paid $8.90 for agreeing to this put contract. Therefore, whether you end up buying Tesla for $320 or not, you will be compensated $8.90. Let's go through 3 scenarios and you'll see the pros and cons. Keep in mind that these are real numbers. We are using Tesla, and with a 320 strike price in the options chain. To keep it simple, I will show you step by step. First, I select the ticker TSLA. Second, I pick the 1-week expiration, which happens to be August 1st, 2025. Then I selected the 320 strike price as discussed in the example. Now here is where it's a little different. In a cash secured put, we are not buying to open, we are selling to open. This allows us to collect the premium. Remember, we are not buying a put option, we are selling.
Next.
Select the number of contracts, in this case 1. We will select uncovered because we are currently not short any Tesla shares. We select limit price, which is $8.75, minus commission of $11.20, and we will be paid a net profit of $863.80. Now remember the deal we agreed to. If Tesla falls to 320 or below in 1 week, then you are obligated to buy Tesla at 320. But if it does not go to 320 or lower over the next week, then you will not be obligated to buy Tesla shares. In this scenario, Tesla stays above 320, so Tesla could go up from the current price of 320 to 350. Or, Tesla could do nothing from 321 and stay at $320.05. Regardless, in any of these events, the price remains above 320. Therefore, in this scenario, you do not end up buying Tesla stock, but you still got paid $863.80. So really, nothing happened. You did not end up buying anything or doing anything, and you made $863.80. But here's the risk and what you always must be comfortable with. Let's say Tesla stock falls to 310 or below that same week of your expiration. In this situation, you are obligated to buy Tesla for 320, and because you're buying Tesla for 320 and it has fallen to 310, you are negative $10 per share. But are you really down $10? Remember that you were paid $8.75 per share? So if you factor in the $8.75 per share that you were paid, then you really bought Tesla for $311.25. And if the price of Tesla is at $315, then you are actually at a profit of $3.75. But I want you to put this into perspective. Remember when you saw Tesla at $320, you liked the stock, and you thought that it was a good buy? By going with a cash secured put, you actually bought Tesla for $311.25, so you got a much better deal on the stock. If you follow this strategy, you will never pay retail prices for any stock ever again. This is why a lot of investors love cash secured puts, because they pick a stock that they want to own at the price they think is good. And they get paid at the same time, and if the contract does not get assigned, then they are going to walk away making money. So it's a win-win situation. Before I go on, I want to share the danger of a cash secured put. I want to show you the nightmare scenario. A Tesla stock plummets to 250 and you are now forced to buy Tesla for 320. So yes, you did get paid the $8.75 for making this deal, making your true purchase price for Tesla shares $311.25, but still the stock fell to 250. This means that you are down $61.25 a share, or negative 19%. So here's my recommendation. If you are thinking about doing cash secured puts, I would recommend doing them only on stocks that you think is a good price and companies you want to own. Now let me put things into perspective. So if you thought that Tesla was a good buy at 320 and you bought it and it falls to 250, then you would be down a total of 21.8%. Whereas with the cash secured put option, you would be down 19%. So even though this is a nightmare scenario with the cash secured put, it is not like you would have been spared or done any better if you bought the stock outright. But I want you to still be aware of the danger. Thanks for tuning in. If this helped you better understand options and how they work, smash that like button, drop a comment below, and subscribe to Pipeline Trading for more clear and educational trading content. See you in the next video. And as always, happy trading. God bless you.